Hello, everybody. Welcome to this new edition of Self-Directed IRA Saturdays. Thank you for joining us. I'm going to give it a few more minutes for more people to join us today. My name is Andrea Chacin. I'm an IRA specialist here at Quest, and we have a great presentation for you guys today. I'm really excited about it. We have Will Thier from Fairway America with really good information for you guys as always. So I'm really excited about that. Before we do get started, though, I do want to run through a couple of things with you guys. I want to talk to you about Quest a little bit. So let's get started. So, who is Quest and what do we do? So, we are the largest self-directed IRA custodian in Texas and in the nation in general. We have about 20,000 active investor clients across the country. We hold about 2.7 billion in assets under administration. We're striving for to get to 3 this year, so big goals for us this year. We have about 108 employees, and about a third of us are certified IRA specialist professionals. So they're really good and educated staff that are always eager to help you guys if you have any questions. We have about 400 million in undirected cash. So for those of you who are looking to raise capital, this is a great source, a resource for you is our clients. So a big disclaimer that we like to go over before we get started. This is for educational purposes only, this presentation and every webinar that we do. We do not provide any tax, legal, or investment advice. This is, again, strictly educational. So if you do ever need advice, we always advise you to go to a professional, a tax professional, an attorney, whoever you need to get your questions answered and to get more information on that and advice. Um, so, what is a self-directed IRA? I know I'll use the term a lot, and some people use it for different reasons, but really, a self-directed IRA is like any type of other IRA that is out there. We just use the term self-directed to differentiate it from your typical IRAs where you invest in publicly traded assets, stocks, bonds, stuff like that, traded in the public market. Over here at Quest, we add the term self-directed so you understand and differentiate your account because you'll be investing in private assets, okay? As opposed to the public. We also use the term self-directed because you will be self-directing your account. You will be choosing your investments and making your decisions that way. You'll just let us know what you like to invest in, of course, and within the private world, within the private sector, and then we'll take you through the process. So what are some of the benefits or having a self-directed area, investing through it? One is true diversification, right? You kind of like not having all your eggs in one basket. Over in the public market can go up and down. It's like a whole world. Over here in the private sector, it's also its own world, and it has its really good opportunities, I guess, to grow your retirement accounts in a different way. So true diversification is a big one. Tax savings. So a lot of tax savings, as you know, when you invest within your IRA, basically we call it tax free. You only have to take care of the taxes whenever you take your distributions. um, and then invest in what you know best. Sorry, my slides are kind of and invest locally too. This is really big. A lot of us don't really understand sometimes when you're investing in the public market. You kind of just put it in a portfolio and you have an advisor to help you with that. Over here in the private sector, you're able to one, if you already know, and if you're already an investor, to really maybe focus on that and feel comfortable actually investing in what you understand. With investing locally, and maybe in a company that a startup, private company that you believe in, etc. So it has those really good qualities, and that you might not find in the public sector, right? Here's some of the examples of what you can invest in, right? In real estate, single family, foreclosure, syndications, options, subject to rentals, fix and flips. So kind of like the same thing you would do outside of your IRA, you can do it with your IRA. Private entities, so LLCs, LPs, JVs, trust, oil and gas, cryptocurrency, and we also have promissory notes, which is private lending, so to speak. So a lot of options. These are just some ideas so you can have a better understanding. So yeah, a little bit more on what we do. We like to provide a lot of education, such as these webinars that we do every Saturday. And we also have, so every Saturday at noon, we also have our Tuesday classes, webinars. So because we're big into educating our clients and our future clients so that they really understand this world and what they can do and how they can grow their retirement accounts through investing with self-directed IRAs. We also have a national networking happy hour that occurs once every month. This is a great opportunity if you're outside of Texas to join. You network. You're able to have a pitch too if you're looking to raise capital, or if you are looking to deploy your cash within your IRA and invest. This is a great opportunity to join us. We always post our webinars and our classes on our YouTube channel. We'll have a huge YouTube channel with a lot of videos and resources. So if you ever have any specific question, I advise you to go there and check it out. And because we have a lot of different videos on different topics about self-directed IRAs. We do have a hybrid self-directed IRA social that we call. This is if you're in the city of Houston, Austin, or Dallas, every first Tuesday, second Tuesday, or third Tuesday, respectively, of the month. So we do have free drinks, free food. You can come in, network with people who are in this world as well, so you can get to know other people and maybe find your next deal, maybe just have a partner to talk to your future project. So really good resource here, to an opportunity to do some true networking. And so encourage you to come out. We always bring a speaker on a topic, and then after the speaker is done and after the networking session, we have a little pitching session at the end too. So if you're also looking to deal pitch and etc., you can come and join us. Bear with me, we're almost towards the end here, but I do like to point this out because we do have a really good referral program. If you refer someone, you get a credit of $25 towards your account, as well as the person you refer to, they also get $25. This is year round. You can use it as many times as you like to, so it's a great thing to know. Last but not least, we do have a boot camp coming up. We're bringing them back after a couple years. We used to have them on a regular basis. We're bringing them back. We're really excited about this one. It's called Masters of Tax Avoidance Boot Camp on March 30th in Houston. It's going to be awesome. It's going to have be on oil and gas. That's the theme for this one. However, it's going to also have a lot of real estate education, as well as self-directed IRAs, of course. So if you're in the city of Houston and you like to join us, please do. It's going to be amazing, really important. And so yeah, we'll hope to see you there. This is how you can get in touch with us. We have a great team of IRA specialists, really knowledgeable and really eager to help you guys. Again, my name is Andrea, but like I said, we have a team of about 6 really great IRA specialists that are always happy to help. So yeah, call us, email us, and then yeah. So without further ado, let's bring up Will Thier and start with him. Hi, Will. Thank you for being here. Go ahead and take it away, please.
Okay, thanks. Hi, everybody. My name is Will Thier. I am partner and COO at Fairway America. Fairway America is a private equity investment manager, and we focus on middle market real estate investments. So, Andrea, thanks a lot for having me on the show this morning, and I'm excited to share some ideas with your clients. So, today I'm going to be talking about built for rent investments, and I'll be going over what those are, the supply and demand dynamics right now in the market that relate to this asset class. I'll be talking about the investment strategy and business plan for these kind of investments. I'll give an example of the return profile and kind of what that looks like, and then wrap up with some due diligence considerations for when making these types of investments. So, all right, let's jump right into it. So, all right, built for rent, what is it? So I'm going to explain a slight nuance here, and it is slight. There's a spectrum of different types of single family income producing investments out there in the United States. So on the left side of the slide here, you can see there's just the general existing housing stock that's out there in America. It makes up the majority of all homes across the United States. They vary in age, ranging from relatively brand new all the way to homes that were built as much as a century ago. These homes, of course, are originally sold to new home buyers from builders, and then over time they get sold and resold to new homeowners throughout the decades. So this is what I would describe as your normal single family housing. And the majority of people that are investing in these are what I would call small, quote, mom and pop investors. That's really just private individuals who purchase a house or a duplex or what have you. And but also there's another class of investors that have begun purchasing single family homes since the Great Recession of 2008. And these are some of the large REIT aggregators, and you can find those. They're publicly traded REITs. A couple of the largest ones are Invitation Homes, American Homes for Rent, and Tricon Residential. And these are groups, they're large firms that have Wall Street backing, and they went in after the great financial crisis of 2008, and they started buying up homes, across America. But it was hodgepodge and here and there, and it's kind of scattered housing, right? And they did concentrate in certain markets, but it's not as though they went in and purchased entire subdivisions of homes. So then flipping over to the right side of the slide here, and this is where I'm going to explain a slight nuance. We have build for rent, build. So that is what has developed recently over the past several years. And at a certain point, once these larger REITs had purchased all of the homes that they could at a good price, and then the housing market had recovered and prices went up and it became more competitive and their margins started to get compressed, they and others started to move into this concept of, hey, well, why don't we just build a completely new subdivision like any normal home builder would, but instead of selling the houses one at a time to individual home buyers, we're just going to keep the whole thing and we're going to put each individual home up for rent. That's going to give us a lot more economies of scale in terms of operations and property management, because all the homes are all right in one place. So this is ground up development that is developed intentionally for renting out to renters. It's generally corporately managed, and a lot of the properties, subdivisions are highly amenitized. They have club houses or park space, those types of things. And in a lot of cases, these investors are trying to provide a premium product. We've seen a shift in renter behavior as of late, and I'll get into this a little bit more, where people are choosing to rent homes rather than buy them, and it's becoming more of a preference over time. But again, this ground up new subdivision development being developed intentionally as rental property, that's being done by more of the large institutional firms. And then in the middle of the screen here is this kind of in between class, and that's what I'm going to call built for rent. And so the difference between build and built is just a slight nuance. There's not a lot of difference in terms of the property type itself, but it's more about the situation. And so, and this is something that has developed really just recently as a result of the current economic dynamics. So these are subdivisions who have been developed initially for the purpose of being sold to homeowners. These are the large traditional home builders out there in America, D.R. Horton, Lennar, and then also smaller local and regional firms who are doing what they've always done, which is to buy land out kind of on the outskirts of town, and then they develop it and they put up, you know, new subdivision housing, and then they sell those one at a time to home buyers. What makes a built for rent property built for rent is really the idea that that whole development process has already been completed, and the homes have been built, and the homeowner, or excuse me, the home builder is now moving into the sales phase. But something has gone wrong. They aren't selling the homes as quickly as they expected to, or there is some other issue that arises that puts them into, I'll say, a semi-distressed situation. It's not fully distressed because these are usually large going concerns who have, you know, pretty stable balance sheets, but the situation does incentivize them to be motivated sellers because they are trying to maintain their operating margins and their revenue flow. So who are the kind of investors that are playing in this space? It's really more of the private equity investors. So folks like Blackstone, Tryon Properties, my company, Fairway America. And so this is a little bit more of an opportunistic strategy that is going to exist for a certain period of time while these economic dynamics remain in place, which I'll get into right now, or in a moment, excuse me. So let me just drill down just a little bit further into what are these. So again, like I said, they're designed to be sold to homeowners. So they tend to be, in some cases, higher quality than the build for rent product that the REITs are putting out, because the REITs are putting them out specifically with the purpose of renting them out. And so some of the finish levels that they put into the homes are not the same as what a traditional home builder would put into a home if they're selling it to a new home buyer. It's finished construction, so you're not purchasing the land and going through all of the entitlements and construction. You're purchasing a subdivision that the home builder has completed. Usually it's between 100 and 200 homes, but that can vary, larger or smaller. And again, like I said, it's a bit more of an opportunistic situation. In terms of when the acquisition timing takes place, it can take place really any time after the certificate of occupancy has been issued for the homes, and so they're ready to be sold or they're ready to be lived in. And what will sometimes happen is that the home builder will complete their subdivision, and then they will begin starting to rent out the homes. And so there may be tenants already in a few of the homes when you, the investor, acquires these subdivision properties. Or you can pre-negotiate while they're still in construction that you're going to purchase the subdivision at the point in time when they, you know, bang the last nail into the last home. So who uses these? Well, there are two general groups of people. There are renters by choice, and these are folks, like I referenced, who They're actually fairly high income earning people, but they have a lifestyle that either they move around relatively frequently for their job, or they just have a lifestyle that allows them to kind of avoid all of the responsibilities of home ownership. They just simply rather rent and have their property be managed by a professional property manager. So, but they still want the experience of a single family home and the privacy and the spaciousness that allows for. A lot of times these are young families, as you could imagine, and what they often are looking for is, or what they appreciate about it, is that they're getting new home quality and finish levels within those homes, but without having to go through the purchasing process and needing the down payment. There's a lot of people out there who simply don't have the down payment at this point in time, or at that point in time in their lives, but they're looking for a place to settle down and raise a family. And so these kind of large managed subdivision communities are attracted to them. And it also provides them usually with access to new schools, because these are being built in kind of new growing areas, as well as new amenities, new retail and other sorts of amenities that are nearby, as well as usually it's in areas of job growth as well. So what is attractive about this kind of property from the investor's perspective? Well, for one thing, the tenants are relatively sticky. What does that mean? Well, it just means that when a person who's got a family, for example, moves into a house and they're a renter, they tend not to move out that frequently. They're more interested in stability and predictability versus your typical renter who is renting in a large multifamily property that's maybe 1 or 2 bedroom apartments. Single family homes are more desirable for tenants than multifamily. Given the choice, if the pricing is relatively the same, a person will generally prefer to live in a home versus living in an apartment building. There are exceptions to that, of course, but I would say the majority of people would pick a home over an apartment if provided, all other things being equal. Because of these two things, because tenants stay in the properties for a long time, and because there is a just generally higher demand to live in single family housing rather than multifamily housing, what this produces is pretty steady and predictable income to you as the property owner. Additionally, because these are all brand new homes, the maintenance that is required to keep them operating is much lower. You don't have the kind of maintenance issues that you would encounter with older real estate property. So replacing roofs or plumbing issues, all of the kind of things that just wear down over time, as people live and use a space. And then the last thing that's attractive from an investor's perspective is that there is some disposition optionality with these subdivision properties. So you can either sell the entire subdivision to another investor, such as yourselves, but you can also sell these homes off one at a time to home buyers, or you can potentially even sell them to the tenants who are in the properties in certain circumstances where that makes sense. So, that's a big important part of making a smart real estate investment. Is before you initiate your investment, you should have a plan for how you plan to dispose of the property, and that needs to be thought through before you make your acquisition, so that you at least have an idea of how you would be able to liquidate this investment at the point in time when you're ready to do that. Okay, so moving into the supply and demand analysis. So, why now? Why is this an opportunity now? Well, it mostly comes down to demographics. So we have a large, sizable portion of the population, millennials, who are now moving into their prime family formation age range. I'm at the very leading edge of the millennial generation, so I'm one of the oldest millennials. I'm right on the cusp. You could probably call me Gen X as well. But most of millennials are about 5 to 10 years behind me, which means that they're like in their early 30s, which is when they begin to form families and then look to move out of the larger cities and into the suburbs and kind of find a place where they can raise a family. And as you can see, over the next 10 years, that population between 30 and 50 is expected to grow by nearly 10%. Another thing that is driving demand for living in single-family homes and living in these rental communities is the work from home dynamic that has come about after COVID. And so, we all went home and worked from home in 2020 and 2021. And so far, less than half of workers are back in the office. I think that is probably going to remain a fairly long-term trend. I think it will trend back up over time, but I don't think it's going to go back to 100%. I think that there's a lot of benefits that people get out of working from home. It's something that the labor market now has set as an expectation. And if you're going to work from home, it's a lot easier to do when you have an entire house to find a place to work in, find a quiet part of your home where you can shut the door and do your work. And as I was saying, also, just due to rising interest rates and the increase in home prices lately, record low percentage of Americans actually think that right now is a good time to buy. So 70% of Americans, given the choice right now, think that renting is a better decision than to purchase a home. And the chart on the right you can see is just depending on the number of children that you have, whether or not you're more prone to gravitate towards a multifamily property or a single family property. And clearly, once you start having children, the preference moves over to single family housing. So, okay, this is a chart from the Census Bureau. Really, all this is meant to show everyone is that the number of households in this country continues to grow. This chart is specifically the number of renter households. It's the number of people that consider themselves renters. That little dip there on the top right corner is a factor of COVID, and you can see that it is snapped back to more or less the historical trend line there. So we're going to continue to see the creation of new renter households, and those new renter households are going to need some place to live. Meanwhile, the affordability of homes to purchase has gotten very difficult. So the median home price rose by over 40% since the pandemic began. The chart on the top right there is a chart of the median sales price of houses sold in the United States of America. That little gray vertical bar over on the right side is basically the beginning of the pandemic. And you can see how just as soon as as we entered the pandemic, home prices just took off. On top of that, to make it a double whammy, this year, the bottom chart shows the housing affordability index dropping from 140 down to below 100. 100 suggests that a home is roughly affordable for the median income household in an area. So we're now below 100, and we've made a huge drop from 140 down to upper 90s over just the course of 1 year. What is driving that? It's primarily the combination of that rapidly increasing home price that you see in the top graph, as well as the massive jump in mortgage rates over this past year. At the beginning of 2022, mortgage rates were about 3.25%, and by November, they had doubled to 6.5%. Now, some of you might be thinking, well, I remember when rates were 6.5%. It's not that bad. I bought houses at that rate. I did too. I remember when interest rates were that high. The difference is that home prices were not as high as they are today. And so when you double the interest rate, that doubles the payment for people. So it's really not about the nominal rate of 6.5 that's the issue. The issue is that 6.5 is an increase of 100% from where they were just a year ago. So it's about the relative change in the interest rates. So those two things together have resulted in home affordability just being, in my opinion, absolutely crushed, which means that rental demand will continue to grow until home prices either come down or interest rates come back down to where people can afford the prices that are currently prevailing in the market. If you listen to the comments from the Federal Reserve, their expectation is that they're going to leave rates high for the rest of at least this year. And if you look at their decision-making process, it's all primarily dependent on getting inflation under control. But inflation, 30% of the CPI is rent, is housing. And so if the cost of housing and rental rates stay high, which I expect them to do so, that means that the inflation rate, even if everything else falls, car prices, food prices, energy prices, the rate of inflation is going to remain stubbornly high. And if the Fed sticks to its, at least its stated policy of continuing to keep interest rates high while inflation is high, that means they're going to have to leave interest rates up for longer than they otherwise would. So I think that this dynamic is going to continue to push people into the renter pool because they simply can't afford to buy homes right now. So moving over to the supply side of the picture. So we have had an accumulating deficit of new housing since the great financial crash of 2008. If you look at the right side of the chart there, where I've circled, what this chart is showing you is the ratio of housing units to new households formed. So anytime that the orange line is above 1, that means that we're producing more housing than new households are forming. Anytime it's below 1, that means that new households are forming faster than we're building new housing. And since 2008, we have not been building houses to keep up with the rate of our household formation in this country. And it's just continued to accumulate to the point where we are now approximately 5 million homes behind. And that means that even if our population stopped growing, just stop. Everybody stop having babies. No new immigration let in the country. The population's just flatlining. The home builders would still need to be building homes at the same pace that they were last year for 3 to 4 years straight before we brought the housing supply in line with the household demand for it. And of course, that's not going to happen. Our population is going to continue to grow. Meanwhile, the home builders are similarly struggling with this increase in rates and increase in home prices to the point where they are now struggling to produce houses. The rate of housing starts with home builders dropped by 38% from April to November because they are reacting to the market. As those interest rates went up, people pulled back on their purchasing because they couldn't afford to buy a new home. And so the velocity of sales that the home builders were seeing started to drop off a cliff, which then they have to react to that, which means that they stop beginning building new homes because the demand has gone away. Well, that's just going to exacerbate this deficit over time. Okay, so what is the investment strategy with these built-for-rent properties? As I've shown, home buyers can't afford new homes right now because of high prices and high interest rates. Therefore, the backlog of inventory that is being held by the home builders is growing. But home builders, they're going concerns. They need to keep their revenue flywheel turning, which means they need to sell these homes. They need to move their inventory. Okay? And furthermore, home builders build homes. They aren't in the rental business. So they don't have the management infrastructure to manage, 200 tenants in a spread out subdivision property. That's not their business model. So that all comes together to create a dynamic where home builders are becoming more and more motivated sellers. And you can see this in the concessions that they're providing to new home buyers. They are offering to pay all of the points on the loan to pay down to get the interest rates down, along with a whole bunch of other concessions. They're pulling out all the stops to try and move this product. Their business model traditionally has been that they want to sell these homes for a margin above their costs, right? They're not necessarily looking at it the way that we as investors look at it, which is to look at it on a yield basis of ongoing income. They're just trying to make a margin on the cost that it cost them to build the house. And so if, as investors, we can offer them that margin or close to that margin, and they're able to reduce their inventory and get all of these homes off their books all at one big schwack, that becomes attractive to them. And so there's some value arbitrage going on there because investors price the value of these homes differently than home builders do. Investors price these assets on a capitalized income basis. So what is the net income coming off of the rental stream from these homes versus the home builders who are just looking to make basically a margin, a fixed margin on the cost of their cost of goods sold, essentially. And the capitalized value tends to be significantly more than just the cost plus basis approach. And so you can pay a home builder cost plus margin, but the value to you as an investor is much greater than that. The stabilized built for rent properties, once they get all leased up and are cash flowing, generally trade at cap rates similar to multifamily cap rates, which are some of the lowest cap rates in real estate. Lease-up operations generally last only a single season to get these properties up to full occupancy, maybe two on the long end, depending on when the thing comes online. And this, again, is driven by the fact that there's high rental demand for people to live in single-family homes. Once you get the property fully occupied, then the plan is you spend 2 to 3 years marking those rents to market, pushing them up gradually and optimizing the property operations, property management operations to drive NOI growth, because eventually you're going to turn around and sell this for a capitalized value, which is based on the net operating income of the entire property. So again, at a very, very high level, the conceptual business plan is in year one, while you're leasing this subdivision up, there's minimal free cash flow because you're using what cash flow is coming off of the property for those lease-up operations. But then in years 2 through 4, you refinance the property once you get to stabilized occupancy at a lower rate, so that you then can grow your current yield by increasing rents over time. And then you can hold the property for essentially as long as you wish to in that condition, But eventually what you want to do is sell the stabilized property, again, at cap rates that are similar to multifamily assets. So, okay, this is a busy slide. I'll just walk through it fairly quickly, but it's just an example of the return profile for one of these types of investments. So in this example, the total cost of the subdivision is a little over $25 million. The total equity is in the red circle there on the top left. Roughly $7.5 million is what investors would need to put in. There's also some an $18 million loan that would be put on the property. And that first loan is a bridge loan. It's midway down the slide on the left-hand side. It's a higher interest rate, 8% roughly. And that is designed to get you from whatever occupancy rate you are when you first acquire the property, which tends to be maybe 30 to 50%, up to 90 to 95% occupancy. And the interest payments are capitalized within that loan. So you're making interest payments out of a interest reserve account. Once you get the property up to 95%, then that qualifies it for an agency loan, Fannie Mae, Freddie Mac. And there you can then see in the bottom left-hand corner, the interest rate on those loans is significantly lower, which lowers your monthly payment, which increases your free cash flow thereafter. That is shown if you look over on the right side of the slide. You can see the net cash flow line. It's about midway down in year one to about $150,000. But then after that refinance to the agency debt, that jumps up to $500,000 of net cash flow a year. And again, as I said, once you get to that point, then you just push the rents, moderately thereafter as tenants' leases expire, and you will clock in around a 7 to 8% current cash-on-cash yield, and you can hold the property for more or less as long as you wish to. But eventually, when you're ready to sell the property, you would capitalize the NOI line, which is up towards the top, and what that produces for you is enough cash, because this is now essentially a multifamily product that you've created. It produces enough proceeds that you can pay down your loan. And as you can see in the bottom right-hand corner of the slide there, over the full course, and this is a 3-year example, but it could be longer, you produce enough residual net income that is roughly double what you invested in it. So not bad. Okay, so let me wrap up with some risks and due diligence considerations for this kind of a investment. So on the property side, you need to do all of your regular property due diligence, title research, encroachments, local jurisdictional taxes, all of that, to make sure that you understand that all of those components of the property. You then also need to take a hard look at the construction quality. Not all construction quality of homes is the same. Some home builders do a great job. Some home builders slap stuff together. I'm sure some of you have purchased new homes over the courses of your lives, and you probably know what I'm talking about. There are also potential subcontractor liens. So did the home builder fully pay all of their subcontractors? Are there any liens on the property? So that needs to be checked. And then finally, does the builder offer any warranties, or do the suppliers offer any warranties on the homes that you can potentially inherit when you purchase the property? You also, of course, need to do your market area analysis. So a lot of this is predicated on population growth projections, right? We want to be purchasing these properties in areas that are growing. That's generally speaking these days what they call the Sun Belt. So that's like North Carolina stretching down through Texas, and then kind of up again through Arizona. You want to look at neighborhood amenities. Where is the closest grocery store? What are the schools like? Those types of things are important to people. That's how they shop for homes. They don't just look at the home itself. They look at what's around the home. And then, of course, you also want to look at your competition. What is the new home supply pipeline in that area? Are there a lot of home builders? Are there a lot of subdivisions that are being built right now? At the end of the day, investing always comes back to economics 101, supply and demand. If you're in a local area that has a ton of new supply coming online, that means that it's going to be more difficult to get renters into your property versus your competitor's property. So that's something you need to take a look at. On the business plan due diligence side of it itself, always look at market comparables for both rent and sales. What are renters paying for single family homes in terms of rent in the market? Is that you're not going to be able to charge dramatically more than what the prevailing rate is. So can this investment hit your investment returns at those kinds of rents? That's just an arithmetic problem. Same thing for sales. Are there any sales of subdivisions, these kind of build for rent properties in your area in the recent past? What do they sell for? That's probably what yours is going to sell for on a capitalized basis. Again, that's an arithmetic problem. Does that meet your investment return expectations? We talked about lease up absorption speed again. So that's a critical component of this business plan. You're purchasing a whole subdivision of homes, and most of them are empty when you buy them. So it matters how fast you're able to lease up the homes, because if you take too long, then that's just money that's not coming in. So doing an accurate assessment of lease up absorption speed is important. Finally, also the debt structure. What kind of a bridge loan are you getting? What are the terms on that loan? How long is it? What are the interest rates? Are there any kind of other covenants or performance requirements? That's all important to understand. Where are your bright lines that your lender wants you to remain inside of? And then also assessing the in-place tenants. These home builders, again, like I said, they're not property managers, they're not landlords, they're not in that business. And they're, generally speaking, just trying to cover their costs till they figure out what to do with this subdivision that they're struggling to sell individually to home buyers. And so they may be just slapping people into these homes without doing a lot of due diligence on the people themselves. And so is the tenant quality itself of the in-place tenants decent, or are you going to have to do some tenant turnover work, evictions and things of that nature in order to get the tenant quality up to where you want it, with people who can afford to pay the kind of rents that a brand new home would justify in the market. And then finally, since you're the passive investor, there's somebody else who's going to be doing all of this. So doing your due diligence on who that is, who is the property manager who's going to be working all of these homes and getting people into those homes and collecting the rents and keeping the properties well maintained. Do they know what they're doing? Have they done this before? Do they have the infrastructure and the and the workforce to be able to do that? And then also at a higher level, who's managing the property manager? So your investment manager, what is their competence? And that's people like my company, Fairway America. Does the manager of the investment know what they're doing? Have they done this before? How long have they been in business? What is their investment philosophy? Does it align with your investment philosophy? Do you look at investments and investing through the same lens? That's important. So all of those kind of things need to be taken into consideration before you make an investment frankly, in any real estate, private real estate investment that you might consider. So that is it. I know I covered a whole lot, so I am happy to answer any questions that folks have.
Thank you. Thank you very much, Will. That was awesome. Definitely some really good information. I really like the supply and demand analysis. It's really eye-opening to kind of see and understand why this is a good idea, especially to invest in build to rent investments and especially within the next 10 years here, upcoming future. So a few questions did come in well, throughout your presentation. So I'm going to start with the ones that came in first. And then we'll go down the list. But so the first one from Ram Tenety. Thank you very much, Ram. Is it wise to invest in such properties? He's asking. Um,
Well, all investing comes with risks, right? I know that every investor wants a super safe, not going to lose any money, and it produces, double-digit returns. But that's just not. There's no such thing. The more gain that you are looking to try and obtain, the more risk you've got to take. These properties in particular, I think, are actually very well. I have to be careful about being too bombastic here. They're on the lower end of the risk spectrum in exchange for the returns that they can produce. So in our industry, and you've probably heard this, is the term called risk adjusted returns. So that concept basically means, okay, every deal has a different level of risk. What are the returns that you can potentially expect from each one of those deals? And is the return commensurate with the risk that you're taking? Some deals, you're taking a lot of risk, and you're not necessarily getting that great of returns. Okay, that's bad risk adjusted returns. There are other deals where you're taking pretty modest risks, but your returns are still quite good, just as good as some other deals that are maybe more risky. Those kind of deals would be considered very good risk-adjusted returns. In my opinion, the fact that you are purchasing these subdivisions after all of the construction risk is in the rearview mirror is huge, because that's really where a lot of things can go wrong. The home builders, subcontractors can walk off the job, or they can get pulled away by other home builders who are offering them more money. The material suppliers can run into issues, as we have seen in the last couple of years with all of the COVID supply chain issues. So there can be construction delays, which then delays when you can start your leasing, which then, of course, pushes all of the income out to the right, and time value of money starts to erode your returns. Purchasing a subdivision that's already finished, the only thing left to do is to lease it up and then to push those rents as the leases roll over. It's actually fairly simple and fairly low risk as compared to many other real estate options that are out there.
Very true. Very true. Interesting. Another question came in from Gerardo Carrillo. He says in the 78501 and 78255 zip code areas, I'm seeing plenty of new apartment complexes being constructed. Does your analysis show which areas are getting overbuilt by zip code?
Yes, we do. We do that analysis. We license access to some of the larger national data providers, so CoStar, Yardi, and they are tracking all of the new construction that comes online. And so, yes, we have access to all of the supply data, and we do an analysis, a supply and demand analysis, to make an assessment of, just as I said, whether or not the area that we're considering purchasing a property in is about to be oversupplied. Obviously, we wouldn't want to invest in an area like that.
Okay. Another question from E. Taylor. Is there a minimum number of build to rent homes these guys will build? I'm assuming the builders. How would it work if the investor brought a free and clear lot or lots to the deal and subordinated to construction?
Um, Yeah, that's a multi-part question. So let me try and take it one piece at a time.
Mhm.
I would say that there probably is a minimum size that makes sense for this, because you do want to get a certain economy of scale from a property management standpoint. You probably don't want to do less than, let's say, 50 houses, I would think. Um, just because you're now having to stand up a whole property management operation for just 50 tenants, and it's not, the economical return on that is not great. It's possible, but it's not great. Um, and then in terms of, if you own land and you would like to put that land into the deal as basically equity, that certainly can be structured. That makes the complexity of the deal, increase. And at that point, you're probably looking more at a build to rent than a built to rent. So, you would be putting your land into a deal. You'd have to find a home builder who is willing to, build homes on your properties, and then you would stay in the deal, and then you'd need a property manager to then come in and lease those homes up and get it all stabilized. So that's build to rent, which is a totally valid investment opportunity. It's just a little bit different and a little bit higher risk, in my opinion, than built to rent, where you're purchasing a subdivision that already exists.
Awesome, awesome. Question from Richard Hall. I'm wondering if there has been studies on the effects of increased multifamily supply dampening or affecting BTR, so built to rent demand.
Um, yes, I'm sure there have been. I haven't seen one recently. My intuition would tell me that yes, if there is significant amounts of multifamily product being built in an area, that is going to affect the built for rent product and its viability, because at the end of the day, residential is residential is residential. People are looking for a place to live, and it does all compete with each other to a certain extent. But I also think that single family home product is differentiated enough from multifamily product that if you're a renter, you might be open to considering living in an apartment versus living in a house. But I think most tenants who are out there shopping the market have probably made that choice in their mind ahead of time, and they're just going to look at apartments because that's the lifestyle or the need that they have, or they've made a decision that they want to live in a single family home. I'm not certain that there's a huge overlap between, renters who say are ambivalent to, which one that they go for. But that's just my opinion.
Yeah, makes sense. We have another question from Ram Tenety. Is it 90 or 95% for agency loans?
Good question. I don't know the answer to that right off the top of my head. So I can get the information and turn it over to Andrea. I just don't remember, so I don't want to
Okay,
say, but it's above 90% for certain.
cool. We'll circle back afterwards. Are we talking about buying a home or a complex, sorry, or a complete complex? Financial examples show millions for investment. So I think this is referring to when you had your financial slide.
Yes. So here, I'll back up to that slide. So yes, it is millions to invest. So that, as you can see in that red circle, top left, $7.4 million. So this is not an investment that your typical person is going to be able to do on their own, unless you've just got $7.5 million jangling around in your pockets. So the way that this is effectuated is through what's called a real estate syndication. And so what happens is a LLC gets created, and it's the LLC that's going to purchase this property. But where the LLC gets its money from is from, a couple dozen high net worth investors who put in 50,000, 100,000, 250,000. Larger investors may even put in, $1 million, and they pool their money together until they get enough so that they have the 7.5 that they need in order to go and purchase this property. And then they rely upon an investment manager such as Fairway America to manage that property on their behalf. And then the investment manager hires the property manager and manages the entire investment over the lifetime of the investment. And when there is free cash flow, they make distributions back to the investors according to their pro rata shares of how much of the investment they own. If you own 10% of the investment because you put in 10% of the money, then you get 10% of all the money that comes out of the investment.
Okay. We are running a little bit over time, but I think it's fine. We have a few more questions though, so let me try and get through the. Let's try and get through them. Would Fairway's acquisition model be on buying the entire subdivision, or also portions where some homeowner sales have occurred, where you might have to deal with established HOA rules?
Yeah, good question. We would try to avoid purchasing any communities that already have homes that have been sold. But even if there are a few that have been sold, usually if the majority of the homes are all owned by a single entity, which would be the case, then the HOA is still controlled by that majority homeowner. So we would still control the HOA if one did exist. So there's not that's not a big problem.
Okay. So continuing on, a question from Boonerin, but I think this is more of, are you looking for BTR projects? I have one in Hillsboro. So maybe you can join one of our socials and networking events so you can maybe pitch. Then there's another question from Ying Long. Is there any good online resources to do due diligence?
Yeah, so the first question, if I'm understanding it right, a lot of the BFR acquisition targets that we've got in our pipeline for this year, ironically, happen to be in Texas. And we are planning to put together a short driving tour in Houston in mid-March to take a look at a couple of subdivisions that either we've already purchased and we own, or a couple of new acquisition targets. And I can provide Andrea with more information about that once we firm up the dates and she can share it. Sorry, what was the second question?
Is there any good online resources to do due diligence?
Yes. Yes, there are, but that is one of the most challenging parts for individual investors who are trying to get into the private real estate investment game. You would need to go to county websites to pull, title data. You'd need to buy subscriptions to, data providers like CoStar and Yardi in order to get access to new supply data. There's other, you need to talk with brokers about what a property's been trading for. So, and then the due diligence, of the home builder or and the tenants and things like that, credit checks and things, it all costs money and it all takes time. And generally speaking, it's more time and more complexity than any of us individually as just, private people have to do on our own. And so that's where finding a very competent investment manager who you trust becomes important, because they have the resources and the bandwidth to do all of that and then put it together in a digestible package in like an online due diligence room that they would give you access to, so that all of that stuff is already done for you and you're just double checking it to make sure that you agree with the assumptions, or that, it's like trust but verify, basically. It's very difficult to do it by yourself, though.
Awesome. Okay. Next question. America Homes has built to rent. Can we invest in that subdivision or as an individual investor, as we will be competing with their rental homes?
I'm not sure if I totally follow the question. Is that a question about American Homes for Rent, the REIT?
Let's see.
Oh, yes. Okay. So, yes, you can invest in, I believe you can invest in American Homes for Rent REIT. You can, find it through your stock broker custodian, Charles Schwab or whoever. So yes, you can invest in the REIT. Do our properties compete with their properties? Sure, if they're in the same market, absolutely. But one thing I would say is that, again, they tend to build from the ground up, and they tend to focus on high amenity packages because of the cost of construction. They need to get high rents in order to make a return on that investment. So they need to find the highest, most affluent renters in the market. And the way to attract those is to provide a lot of amenities, which again costs more money. So it's a little bit of a vicious cycle, versus purchasing a subdivision that was originally built specifically to be sold to home buyers, but you're purchasing it from the home builder all as a big package. And that home builder is really just trying to kind of get out of the property and recoup their investment so that they can move on and they can keep their crews employed and they can keep their lights on. So it's a slightly different investment strategy. But at the end of the day, if American Homes for Rent had a subdivision in the neighborhood, and you had a subdivision in the neighborhood, and they were both built for rent subdivisions, yeah, they would compete for tenants for sure.
Okay. Next one we have from Yuki. Which areas are these houses? Also, what's the minimum an investor can put in? And if you can show some examples.
Yeah, so like I said, a lot of these are being built all throughout the Sun Belt just because they're trying to get into the path of growth. A lot of people are moving out of New England and the Great Lakes states, or moving out of California, and they're moving into places like Texas, Tennessee, Georgia. And so that's where a lot of these new home subdivisions are being built. In terms of what's the minimum investment, it's usually $50,000 is at least our minimum, but other places may have higher or lower minimums. In terms of an example, if you head over to our website, we will have a couple of build for rent investments that are coming available here in the next month, and they'll be posted on our webpage. Our website is just fairwayamerica.com. Pretty simple. So www.fairwayamerica.com. I think we've lost Andrea maybe. In terms of somebody else asked about historical proof of concept, we've done 3 of these already that are on our books. And we also have extensive track records on our website of other real estate investments that we have gone full cycle on and returned capital and profits to investors. You can download our entire track record there on our website. So, okay, well, I think I have probably taken enough of all your good people's time today on a Saturday. So I'm just going to sign off, and thank you very much for taking the time to let me present to you. And hopefully I provided some new ideas and new concepts for everybody on the call today. So
yeah. Hey, Will, this is Colin. I'm actually the moderator for today's event. So we'll go ahead and close out here. I'm not too sure what happened to Andre, to be honest, but really appreciate your time today, and the presentation was awesome. So thank you, from Quest, and I know everybody enjoyed it as well.
Okay, great.
Absolutely. Thanks, guys. Y'all have a good weekend.